Hello students, welcome to BBA 432 International Business Management. Today I will be covering chapter 11, the global capital markets. Okay, so we will be basically talking about the major functions of multinational enterprises in a global context. How do firms raise capital? What are the best ways to raise capital? We will define leverage and also talk about how it affects the choice of capital structure. And also we will also explain different ways to access debt internationally. So among the other objectives of this chapter is also to summarize and explain how foreign source income is taxed, and also analyze how offshore financial centers provide financing opportunities for multinational companies. Here are some of the functions, starting with the CFO, right? We will be starting to discuss the role of the Chief Financial Officer, right? In order to cover the learning objective one, which is to describe the finance function of a multinational enterprise in a global context, right? So the most important decision maker and the player, the key player, is the CFO in the global organization, who is the Chief Financial Officer. And the role of the CFO and the financial management in general is to maintain and create economic value or wealth by maximizing shareholder wealth. So therefore CFO is basically responsible for three major decisions: financial decisions, investment decisions, and management of short-term capital. The main responsibility of the CFO, as I said, is to maintain and create economic value or wealth by maximizing shareholder wealth. So the market value of existing shareholders' common stock is the shareholder wealth. The management activities related to cash flows can be divided into three major categories, right? So the first decision is the financing decision, right? Financing decision, especially regarding the capital structure. So when we talk about the capital structure, we're really talking about the proper mix of debt and equity, and also long-term financing. The long-term financing decisions involve selecting, issuing, and managing long-term debt and equity capital, including location, right, home country or elsewhere, and currency to be traded, home or foreign, okay? And the second type of decision involves the investment decision, right? Making investment decisions, typically we're talking about those type of decisions in the context of capital budgeting. And the third decision is management of short-term capital. So what we mean by this management is all about managing the multinational corporations' currency, assets, and liabilities. This may include management of cash, receivables, marketable securities, inventory, trade receivables and payables, and short-term bank debt. Objective learning 2 is all about the definition of leverage and how leverage affects the choice of capital structure. So we are really talking about the leverage in the first category. Leveraging is all about the degree to which a firm funds the growth of business with borrowed funds or debt. Okay? The degree to which a firm funds the growth of business by debt or borrowed funds is known as leverage. Okay? So the degree to which the companies use leverage instead of equity capital, right, varies throughout the world. So we're talking about whether the company uses equity capital versus leverage. The equity capital is also known as stocks or shares. So there are two ways in which a firm funds the growth of business. It can be through leveraging with borrowed funds, or it can be through raising stocks, okay, which is also known as equity capital. The second objective of this chapter is to define the debt and exchange rates, okay. So this issue of debt and exchange rates came to the forefront of international financial crisis, international financial system. The global financial crisis of 2007 and 2009 highlighted the foreign exchange risks. Okay, and leading up to the crisis, many Asian companies borrowed in dollars at relatively very low interest rates, right? But when the dollar rose in value in 2007, these companies wouldn't generate enough cash to convert into dollars to pay off their debts. The third topic that we will be talking about is the regulatory risk. Regulatory risk, it is a second factor and also one of the most important factors that affects local borrowing, right? Local borrowing is also a function of regulatory risk. Regulatory reform has complicated access to debt financing. As we noted earlier, bonds are a great way for companies to raise capital for their operations. However, companies also rely heavily on bank financing, meaning bank loans. And the failure of banks during the global financial crisis and resulting impact on the global economy has made countries and also companies very nervous about the financial stability of banks. So basically the financial stability of banks, as banks became more and more unstable, this also increased the regulatory risks for investors and different countries in the global economy. So learning objective 3 is all about explaining the different ways to access debt internationally. How do companies raise capital? How do they access debt internationally? So there are different sources of raising debt. One of them is the euro currency market, right? One of them is the euro currency market. The euro currency market is indeed a very important source of debt financing to complement what multinational corporations can find in their domestic markets. We can define euro currency as an offshore currency. It's a form of offshore currency. It's any currency banked outside its country of origin, right? Euro currency, also known as offshore currency. It's any currency banked outside of its country of origin, okay? There are some major sources of euro currencies. There are indeed four major sources of euro currencies. Okay, so let's look at those different types or major source of euro currencies. One of them is foreign governments or individuals. Okay, these foreign governments or individuals, they want to hold dollars outside of the United States. Okay, if a company like Apple, right, or any foreign government like a French government, they may want to hold dollars outside of the United States. That is called a euro currency. I mean, the definition of euro currency has nothing to do with euro. Euro currency means offshore currency. Okay, so when the companies or the foreign governments, they want to hold dollars offshore, meaning outside of the United States, that is one type of euro currency. The second type is that multinational enterprises, sometimes they have cash in excess of their current needs. That is also called a euro currency. Sometimes European banks with foreign currency in excess of their current needs, right? Countries such as China that have large foreign exchange reserves. Countries that have large foreign exchange reserves, right? That also refers to euro currency. The third type of financial instrument is the international bonds. Many countries have active bond markets available to their domestic and foreign investors. The United States is the largest market in the world for domestic bonds, with 39.5 trillion outstanding in mid-2015. Okay, which is 1.5 times the size of the US stock market. These 13 bonds are used by governments, financial institutions, and corporations, with corporate issues being the smallest segment. Okay? 70% of the global market is composed of domestic bonds, and 30% are international bonds. Okay? So 70% of the global bond market is domestic bonds, whereas 30% are international bonds. Also, if you think about the global bond market in 2012, it was almost twice the size of the global equity market as defined by market capitalization. So the definition of the foreign bonds refer to the bonds that are sold outside the borrower's country but denominated in the currency of the country of issue. Okay? Foreign bonds, in other words, they are sold outside of the borrower's country but denominated in the currency of the country of issue. Okay? For instance, a French company floating a bond issue in London in pounds sterling would be issuing a foreign bond. Okay, here's an example of the definition that I just described. Definition is the foreign bonds, right? Foreign bonds are the bonds that are sold outside of the borrower's country but denominated in the currency of the country of issue. Right? Think about a French company, right? With issuing a bond in London in pounds sterling would be issuing a bond because the French company is issuing that bond, right, outside the borrower's country. They're issuing it in London in pounds sterling. Therefore, they would be issuing a foreign bond. And then we have something called, under these different types, right, we covered the foreign bonds, and now we're looking at the Eurobond. Eurobond, on the other hand, is usually underwritten. There is a place in the market for the borrower. It is usually underwritten by a syndicate of banks from different countries and sold in a currency other than that of the country of the issue. Eurobond is sold in a currency other than that of the country of issue. For example, think about a French company. French company issuing a bond in London, but that bond is denominated in US dollar. Is an example of a Eurobond. Okay? That's very important. Eurobond is the bond, right? Bond from the different countries, but sold in a currency other than that of the country of issue. For, as I said, a French company issuing a bond in London, and the underwriting is done in London, but that bond is denominated in dollars, in US dollars. That would be an example of a Eurobond. So we covered foreign bonds, Eurobond, and now let's cover the global bond. What is a global bond? A global bond is issued outside of the country where the currency is denominated. Okay? A global bond is issued outside of the country where the currency is denominated. For instance, a US dollar issued outside of the United States in multiple locations. Okay? A US dollar bond issued outside of the United States in multiple locations. A US dollar bond might be issued in Brazil, it might be issued in London, or it might be issued in Switzerland. That is considered to be an example of a global bond. So basically, let's continue with the other learning objectives. After having covered foreign bonds, Euro bonds, and the global bonds, now it is time to talk about the next topic. Which is the international stock markets, right? So basically, there are different ways to access debt internationally, and stock markets being located in different places in the world enables the investors to access to debt internationally. Here, this map shows the major, largest stock markets in the world. While companies access debt internationally, the most important thing to think about is how foreign source income is taxed, because taxation has a strong impact on the choices that the companies are making. Taxation automatically impacts the business choices in terms of where to invest the capital, how to invest, and so forth. Taxation, as I said, has a strong impact on several choices that the company is making. Number one, taxation has an impact on the location of company operations. It has an impact on the choice of operating form, such as export or import, licensing agreement, or overseas investments. taxation has an impact on legal form of the new enterprise, such as branch or subsidiary. Taxation has an impact on possible facilities in tax haven countries to raise capital and manage cash. Taxation also has an impact on method of financing, such as internal or external sourcing or debt or equity. Again, taxation has an impact on capital budgeting decisions. It has also an impact on method of setting transfer prices. There are obviously differences in types of taxes, right? International tax practices widely differ among the countries. Countries differ in terms of the types of taxes they have. For instance, income versus excise. The tax rates applied to income varies among the countries. The determination of taxable income is also different among the countries. So there are other differences, such as the treatment of foreign source income. Although we focus in this section on corporate income taxes, excise taxes are another important source of income to governments. The value-added tax, also known as VAT, is an example of an excise tax used in Europe as well as other parts of the world, including China. Among the countries, there are also other differences which may apply to GAAP rules. GAAP refers to generally accepted accounting principles, right? Generally accepted accounting principles widely differ among the countries. So variations among countries in GAAP can lead to differences in determining taxable income. Differences in tax rates, corporate tax rates, also vary from country to country. As noted in the opening case, corporate tax rates vary from 12.5% in Ireland all the way up to 30 to 35% in the United States. Let's talk a little bit about how the countries tax foreign source income, right? A controlled foreign corporation, right, which is also known as CFC, a controlled foreign corporation. From the standpoint of the US tax code, is any company, foreign company, in which more than 50% of its voting stock is held by US shareholders. And those shareholders are US citizens or companies that each hold 10% or more of the CFC's voting stock. Okay? Any foreign subsidiary of an M&A would automatically be considered a CFC, a controlled foreign corporation, from the standpoint of the tax code. And then there is this issue of active versus passive income. So what does this mean? Active versus passive income from a tax standpoint. For instance, if a foreign subsidiary qualifies as a controlled foreign corporation, the US tax law requires that the US investor classify the foreign source income as active or subpart F, meaning passive income. Okay? The US law, in the case of a foreign subsidiary, right, qualifying as CFC, meaning controlled foreign corporation, there is a requirement in the US tax law that says that the US investor classifies the foreign source income as active or subpart F, passive income. Okay, so what's the difference between the active income and the passive income? Basically, active income is derived from the direct conduct of a trade or business, such as from the sales of products manufactured in the foreign country. Okay, so it means that the company, the subsidiary, is directly conducting trade or business in the foreign country. When we talk about subpart F or passive income, it is specifically defined in the subpart of the US tax code, okay, US Internal Revenue Code. So this type of income comes from sources other than those connected with the direct conduct of a trade or business. Okay? So these comes from sources other than those connected with the direct conduct of a trade or business. That's why we're calling it as passive income or subpart F. A major tax challenge as well as an impediment to performance evaluation is the extensive use of transfer pricing in international operations. Okay? Because the price is between the related entities, it is not necessarily an arm's length practice. It's not necessarily an arm's length practice. That is a price between two companies that do not have an ownership interest in each other. In other words, the assumption here is that an arm's length practice is more likely than a transfer price to reflect the market accurately. So here is a good summary of how the foreign income is taxed. This figure shows, in other words, how US-owned foreign subsidiaries in different parts of the world is taxed. And it's also giving you an idea about how a US parent company might be taxed. Okay? Right? So we have the US stockholder. The US stockholder is the parent company. So it has three types, right? The one is the foreign corporation, which is a non-CFC. Okay? And then we have CFC. Active income is tax deferred in a foreign subsidiary. Subpart F income is taxable to the parent when earned by the CFC. Okay? But this active income is tax deferred, whereas passive income is taxable to the parent when earned by the CFC. And then we have this foreign branch. In the case of foreign branch, all income is taxable to the parent when earned by the branch. Under the non-CFC, right, income is taxable to the parent when declared as a dividend, regardless of whether the income is active or subpart F. In this case, deferral will apply. Okay? Again, we continue to describe how the foreign source income is taxed. So we'll be talking about tax credits to avoid double taxation. Basically, the US tax code, the IRS, allows a tax credit for corporate income tax that US companies pay to another country. Okay? A tax credit is a dollar for dollar reduction of tax liability and must coincide with the recognition of income. There are also tax treaties which are eliminating this double taxation, right? Tax treaties eliminating the possibility of double taxation. The primary purpose of the tax treaties is to prevent international double taxation or to provide some remedies to the companies when this occurs. For instance, the United States is an active participant in 75 different tax treaties involving 58 different countries. The general pattern between two treaty countries is to grant these reciprocal deductions on dividends, withholdings, and to exempt royalties, and sometimes even interest payments from any withholding tax. And let's talk a little bit about some of the characteristics of these offshore financial centers. So these offshore financial centers are important because they provide opportunities, financing opportunities for multinational corporations. So there are offshore financial centers, which are known as OFCs, are cities or countries that provide large amounts of funds in currencies other than their own, and are used as locations in which to raise and accumulate cash. Okay? So usually the financial transactions are conducted in currencies other than that of the country and are thus the centers for the euro currency market. The characteristics of the offshore financial centers are the following. They are a large foreign currency market for deposits and loans, say in London, for instance. So a market that functions as a large net supplier of funds to the world's financial markets, such as in Switzerland, right? So offshore financial centers also provide a market that functions as an intermediary or pass-through for international loan funds. For instance, think about those, international financial centers which operate as intermediaries, such as the Bahamas or the Cayman Islands. Offshore financial centers provide economic and political stability. They are an efficient and experienced to the financial community. They provide good communications and support services. And they also provide, offshore financial centers also provide official regulatory climate favorable to the financial industry, in the sense that it protects investors without unduly restricting financial institutions. Basically, the final objective of this chapter is the operational and the booking centers, right? And how these operational and booking centers provide financing opportunities for multinational companies. So when we talk about operational versus booking centers, it's important to clarify the difference between the two. These operational centers, generally, they have extensive banking activities that involve short-term financial transactions. Okay? Operational centers have these extensive network of banking activities involving short-term financial transactions, whereas in the case of booking centers, they have little actual banking activity taking place, but transactions are recorded to take advantage of secrecy and low or almost no tax rates. So that is the difference between operational centers and the booking centers. In the case of booking centers, there is really no actual banking activity taking place, but transactions are done in a very secretive environment. OFCs, offshore financial centers, some of them include what is known as tax havens or places that offer very little or no taxation to multinational corporations. This is a major concern, a problem with offshore financial centers because it involves the tax avoidance dimension of their activities. The OECD and the other international financial institutions has been working closely with the major offshore financial centers to ensure that they're engaged in legitimate and legal activities. So OECD basically uses the following key factors in identifying tax havens. As I said, tax havens are the places or the countries that offer no or very little taxation to multinational corporations. So basically, this has been a discussion in the OECD saying that, we need to be more aware, be more mindful of the activities of the multinational corporations in these offshore financial centers, particularly in tax haven. So the OECD uses the following key factors in identifying tax havens. So how are the tax havens identified? So OECD uses no or only uses the criteria that OECD uses the criteria that tax havens offer no or only nominal taxes. So there is also in these tax havens lack of effective exchange of information, something known as especially bank secrecy. Those tax havens, in other words, do not share any information with the outside governments, right? So there's this lack of effective exchange of information between a tax haven and other countries. Okay, there is also lack of transparency, and sometimes in these tax havens there are no substantial activities taking place other than hiding the assets and the income of multinational corporations or very wealthy individuals from different parts of the world. So again, summarizing the key characteristics of the tax havens are countries or entities that offer no or only nominal taxes. Okay, in these environments there is lack of effective exchange of information known as bank secrecy. There is lack of transparency. There are also no substantial activities taking place in those tax havens other than hiding or accumulating the hidden incomes of multinational corporations or very wealthy individuals from different parts of the world. Again, in this chapter, we talk about the characteristics of global financial markets, the global investment markets, and how corporations raise capital using different instruments, including euro currency bonds, foreign bonds, and global bonds. Again, thank you for listening to my lecture, and in the next chapter, we will be talking about strategic investment, and also we will also be talking about foreign direct investment. Thanks again. Have a good night. Bye-bye.